Um, Hello, everyone, and welcome to the Africa Startup Funding 101 as part of the MEST Africa series. For today's session, we have a very interesting panel discussion for you. We've been able to get together two amazing founders who have raised recently and who are willing to share their amazing stories. So as an alumni of MEST, I'm extremely excited to be having a discussion with these fine gentlemen who will share with us some of their war stories, some of their pitfalls, some of the challenges they've gone through. They will share with us, give us advice on what steps to take, what they spend their time doing. I think I would be remiss if I did not speak about MEST before going on with this conversation, especially since all of us happen to be MEST alumni. First and foremost, MEST is an Africa-wide technology entrepreneurship training program that is funded by the Meltwater Group. And the goal is really to inspire young Africans to establish viable startups that scale globally. So that's why we're here today, to learn from these panelists. So without much further ado, I'll go on to introduce these panelists. We have Henry Mascott. First and foremost, we have Paul Damaley and Henry Mascott. So Paul Damaley is the CEO of Approve, and Henry Mascott is the CEO and co-founder of Curacao. So I will try to introduce both of these fine gentlemen. I will probably fail, and that's fine. And then I'll give them a chance to introduce themselves and then give us a even more in-depth analysis of what they do. So first and foremost, Paul Damaley. So Paul Damaley is the founder of Approve. It's a product of the Inclusive Innovations, Inc., which is the name of the company that he's founded. But it's really about providing a service that enables financial services verify data across the life cycle of engagements of their products. So Paul has advised on several panels, he's on several boards, and he will tell us a lot more about that. Welcome, Paul. And please feel free to introduce yourself before I move on to Henry.
Okay, thanks, Emmanuel. Hi, everyone. My name is Paul Damaley. Sorry about that. My name is Paul Damaley, CEO at Approve. Like Emmanuel said, Approve essentially enables our customers verify, customers they are onboarding. So be it individuals or a business, we essentially verify data that they collect. So if a company is onboarding a business, they could be presenting their business documentation, financial information, etc. Approve enables that to be possible, to be verified, the people behind the business and any necessary information. If it's an individual, then you're talking about their ID documents. We verify that data. We do that across 5 African countries currently. So that's Approve in a nutshell, really.
Awesome job. I've had the chance to interact with Paul about the service he provides, and it definitely has global potential. So super interesting to hear more about what Paul and Approve provide. Let's move on to Henry Mascott, who I've had the pleasure of mentoring for a bit, but it's interesting to come all the way back. So Henry is working in the health space, providing an AI learning solution for health insurance companies across Africa. So Henry, the ball is in your court. Please go ahead and
yeah. I like the way Emmanuel always says it. He always says, "I'll introduce you and I will fail." Thank you very much, Emmanuel, for the platform. My name is Henry Mascott. I'm the co-founder and CEO of Curacao. At Curacao, what we're really working on is trying to build infrastructure to ensure the next billion people across emerging markets, right? So right now, if you meet 100 people in anywhere in Africa, only about three of them would have any sort of insurance. So our mission at Curacao right now is to say, how can we enable more people get insured. And in that light, we have a couple of products that we're working on. Our flagship product is a product that helps insurance companies pay claims faster. Because we understand that one of the biggest issues with insurance is people don't trust them. So trust them to pay claims. So that product is helping insurance companies sort of like process claims faster and pay faster. And we've gone beyond that to build out other products that basically help insurance companies to be more efficient and help more people to be willing to buy insurance. Happy to be here to share my journey around raising funds. Cheers.
Awesome. Thank you so much. Thank you so much for being with us. So we'll jump right in. I think we'll start the discussion. I'm humbled to be here amongst these co-founders. So let's start with the discussion. So I think to both of you, my first question would be, and this comes from sort of the product background. Why did you even go ahead to raise funds, and why? And if you're comfortable with that, sort of, how much did you raise? How much have you raised? And then how easy was this in a very general sense? Paul, I'll start with you.
Okay. I think the decision to raise funding really depends on the kind of company you are building, right? If you say you're trying to build a global business or a Pan-African business, most likely it has to be venture backed. So, I mean, of course, we decided to go the route of venture backing, but with a sense of knowing that you still need to build a normal business, And the reason why I say that is that there's also venture engineering, right? And we'll talk more about that later during the call. But essentially, the last time we raised was last year, October. To date, both in venture backing and grants, we've raised about $500,000. And yes, since then, we've just been focused on putting the company in a good revenue position as a company, serving our clients, and that's really been our focus. So generally, yeah, the decision to raise funding really boils down on the kind of company you're building and how fast you want to grow it. And yeah, we decided to raise some funding to give us the ability to secure, some regulatory licenses, also have some good talent, and just focus on building a company that can scale across the continent, because that's really what our clients need. Awesome.
Sounds good. And it makes perfect sense. Money can sometimes be an accelerant. So that's sort of what you are looking for. Henry, how about you? Why did you raise? And if you feel comfortable, please share with us.
Yeah, sure. No, I think we've raised them. So our pre-seed is cumulatively similar to, again, Paul's $500,000 as well. And again, we've also had like a bit of grants here and there recently from Google as well. So so I think Paul has already sort of like, given the foundation, right? So you raise, so there are different sort of like funding types. You can get debt, you can get a PE, you can get VC. So depending on sort of like the business you're building and what is available to you, right? You take one of those options as well. So for us, we've always wanted to build like a big business, global, Pan-African. And we did start out we're profitable. We had a client, it's a small team, we're profitable. But we also realized that, we're trying to grow the business, our revenues, right? We wouldn't be able to like hire as much people, grow as fast as we want to, as well. So we went towards the venture route, and we're still on that path, because again, it's not just about the money, right? But it's also the mindset, right? It's a totally different mindset, when you're trying to build a high growth business. So you have to try to move quickly. How can you move quickly? The ideology that the investors also bring to the table is also, so we, for us, it was more of how can we grow faster? How can we do this in 5 to 10 years instead of 20 to 40 years as well, right? So I would say that is why we went that path, which is also why we continue to look at ways to evolve our business and make sure that we are in line with that part as well, because we've also seen that, also beyond just the money, it also just changes how quickly the founding team grows as well, right? From an execution perspective. So yeah, so that's why.
Yeah, I think it sort of brings up, it moves very nicely to the next question I sort of have, and I'll start with you this time, Henry, because you sort of hinted at that a little bit, and what do you end up using the money for? I think that's what that's very curious. Like,
yeah, no, so again, it depends on the nature of the business, right? So like Paul mentioned, yeah, okay, go.
And I think sometimes when we talk about funding or even someone investing in you, and sorry to have, we tend to think so much about the money, but then there's so many other benefits that come. So what do you use the investments for, and how does it affect you?
Yeah, so when I think about it, right, so I think the most important thing when you're running a venture-backed business, and we're seeing this recently in the past 1 year, because the ecosystem has totally changed in the past 1 year. So the most important thing is always the mindset, right? So, a startup, right? If you're a fan of Paul Graham, which I am, right? Paul Graham would say startup is equal to growth, right? It's just about growth, right? It's not about, so again, it's not everybody subscribes to this ideology, right? But there's the ideology that, like, it's not about the problem you're solving. It's not about it's just about growth. Like, how do you grow? So it's like anybody who has decided to build like a startup, again, in that ideology, if you're trying to build a VC-backed company, is that you're subscribing to grow, right? And you grow quickly, grow as much as you can. So the most important thing I've realized is a mindset. Again, I've been, when we started, our first product was basically your product that you guys sold as well, right? So we've evolved that a lot from there, and it's also because we've been iterating towards how do you turn on something that just grows quickly. So for me, the mindset, it's a mindset. So when you're raising, it's a mindset. So it's finding people who understand that you need to grow quickly. So they bring the money, they bring the networks. So the money is one of it, because money helps you hire engineers, hire salespeople, but then the networks as well. So you get introduced to, so right now, because we're Pan-African, Curacao right now, we are operational in three markets. We're turning on maybe another 6 before the end of the year. So when they come in, they bring in, those networks, right? As well. So for me, it's the mindset, it's the capital, the networks, as well, which is why right now, thinking about fundraising, I prefer the American investors, because their mindset is always like grow quickly, So for me, it's mindset and then capital.
Cool. Paul, what about you? Any thoughts on basically what do you use the money for, and then what other benefits do investors provide?
Yeah, so in my case, we use the money to hire. That was the first thing we did. Second thing also we did was to secure regulatory approval, because our business is heavily regulated. And we just focus on building the product, focus on the customer, figuring out what best works for the customer. Africa is not a homogeneous market, right? There are some markets that are way advanced than others. And so trying to figure out that means that you also need to hire talents that understand each market that you go into. I spend a lot of my time across multiple markets where we are, and I work with the locals to understand their markets, to understand what is needed for our customers, and try to execute for the customers. And so, yeah, that's what we do with the money.
Yeah, awesome. Thanks, Paul. I think that, so in the next question I have is, how long does it take to raise? How from the time when you start a conversation with an investor to the time when the money potentially hits your account? How long does that take, Paul? So that,
Okay. Are you done?
yeah, the reason I asked this is so that, thanks for the reason I asked this is so that it sets the right expectations for potential founders so that they understand how much work goes into this. So yeah, I'm done with the question.
Yeah. That's good. So fundraising doesn't start from when you start speaking from with the investor. It actually starts from the work you do in-house, right? And so typically, the first thing that we need to do is investor readiness, right? So investors want to see really understand your business. They want to understand your vision. They want to understand where you're going. And for you to do that really well, you need to do an evaluation of your business internally and understand where you are as a business and where you could potentially go if you're given X amount of money, right? And so typically that's where it starts. You try to understand where you are in terms of your KPIs, the strength of your team, and try to make an evaluation of all the resources you need in order to grow at a certain rate. You and your team has to determine how fast you think you want to grow and what is required for you to achieve that. Based on that, then you do all the the typical things that you have to do. Prepare a due deal room, where you have all your documentation about your business, KPIs, your business plans, etc. You have it there, and then you start to build a funnel, right? Now, most people in Africa tend to sort of be very generalist when it comes to raising funding because I don't think we've gotten to that point where we can afford to say, I just want specialist investors, right? When you say specialist investors, you have some, for example, Henry would have some health-focused fund investing in them. And they say, okay, we want to raise from these kind of funds alone. But I don't think even Henry will do that, right? You try to raise from as much people as possible, so far as they have money and they can help you. And that's what it looks like from the continent. Everybody has, their choice. It's your choice. You decide to do what you want to do, but you have to build a funnel. And building a funnel also means evaluating the investor, trying to do some research on them, knowing who the lead decision makers are, speaking with friends in your network to know whether they've raised from them before, their performance with them, etc. So you do all of that, then you start prospecting, right? You see that you get introductions, which are probably the most easiest way of getting through to investors. And that's why it's good to keep in touch with other fellow founders or try to join networks where you can actually get in touch with fellow founders. If you're lucky, you get inbounds also. When we were raising, we got a lot of inbounds. And so, yes, I think it's also important that to an extent, depending on your kind of business and what you feel like sharing in public, it's nice to share in public because people will follow you on Twitter, especially. People will follow you just to keep track. Investors really have a lot of money and they want to deploy. If they're not getting founders to invest in, then they are not getting business, right? And so some way, somehow, you have to put yourself out there. And the way you put yourself out there is to talk about your business, the industry, and insights you are learning, right? And so this is how I, over the past year and a half, have raised money. And this is what works for us, basically. Yeah.
Cool. That's a wonderful answer. Very detailed. Really appreciate it. I think you mentioned something, and before I go back to Henry, you mentioned something about sort of nurturing a relationship and keeping that, talking to different people within the chain within the same company. How do you maintain that? How do you ensure that, aside from the due deal prep that you do, how are you managing that relationship? How much of your time is spent doing that personally?
Well, there are different ways of maintaining a relationship, right? Usually, senior entrepreneurs, I'll reach out to them and speak with them. So let's say GB from Flutterwave.
Yeah.
He's an investor in my company. You talk with them, right? The other way is like if they're in town, you host them, right? So I mean, Henry was in town not long ago. We just meet up, talk. We chat in groups also. It just happens that we belong to groups, mutual groups, and so we do that. And then if you have questions or things that you are curious about or you don't have an idea about, yeah, just ask. So far as you can reach out to them. So yeah, I think that these are the ways you maintain these relationships, and it helps. I also travel to various markets and I meet various founders over there. Yeah, if you can be of value to people in any way, you do that. I always do that. People always ask me for introductions and stuff like that. And if I feel like it's worth my time, I definitely do it. Yeah.
Thanks, Paul. Really, really insightful. I hope everyone on the call is sort of learning from all these amazing stories that we're hearing. So back to you, Henry. What would you say is the biggest challenge to raising funds as a startup? What would you say is
the biggest challenge to raising funds? Yeah.
What has it been for you, the biggest challenge? Maybe.
So again, so the funding climate. So I started. My pre-seed was pretty much early last year. Like I started early last year, close towards the end of the year. So I feel that there is so that the maturity of the startup space or the technology startup space in Africa right now is slightly different compared to the way it was last year, 2 years ago. So again, because of all the exits and there's been like massive momentum in the industry right now. So I'm yet to experience this because we're just about to start raising our seed round. So but for last year, right? So I would say that a lot of the biggest, again, when it's your first capital, right? The biggest challenge is always like, you don't have nobody knows who you are, right? It's like, so it's not like, I say it gets easier, right? Because, you raise a bit of capital, you have people who've trusted you, you've been able to get a lot more traction. But in the beginning, I think the challenge is, not really being known, right? So you don't have any brand, you don't have anything. So you're having to introduce what you're building for the first time to these guys. And again, obviously for us, right, it wasn't the first time actually. We've tried to raise before, like with one of our former products, and then it didn't quite work out. So I've actually failed to fundraise a few years ago. So you can actually fail, right? So we failed to fundraise, we pivoted the business, did a few things, got a traction, and came back to the thing and we're able to raise. So for me, right, the biggest challenge, if I think about the last round we did, was just showing up and people not just knowing like who you are, first time founder and all that, right? And again, when you're in the beginning, when you're raising like your pre-seed, you don't have a ton of traction yet as well, because the first capital, you probably like, back then, this was like maybe 2-man team, 3-man team. So we're not building as fast, we don't have as many clients. So the investors just really believing that, again, what makes it easier sometimes is like for the founder, if you have some level of pedigree, you've worked at Google, you've worked at Microsoft like Emmanuel, So now they need to compare it with something. They need to be able to show that, okay, you're selling all these big things where you can actually like get it done, right? So that's the hardest one. So I think subsequently gets easier if you've gotten to some traction, they've seen some momentum over the years. So that was it. It was challenging, but for us as well, what also helped us was that we also went through programs as well, right? So we went through Startup Bootcamp, which Paul also did, went through a few programs. So those programs helped sort of like give us some level of inbound, right? Because the biggest thing, like Paul did a very good job in talking about the process, right? The fundraising doesn't start like you just do a deck and no, there's a bit of relationship building you have to do first. And I also realized for this round, we're doing things slightly different, is that you talk to a lot of founders, right? Like, you pitch founders first. So before you pitch investors, you actually spend a lot of time pitching other founders, and then even getting founder checks, because then those founders can even introduce you to their investors and all that. So yes, I would say is that first inbound, that first lead generation that was the hardest part for us in that round.
Yeah, thanks for that. I think you mentioned something about your failed raise. Would you like to share a bit more about that? I think many people think that, well, if you have a successful business or even a thriving business, there's some traction, you have a business, it's easy to raise. Nobody, and Paul also alluded to this, that very few people share their stories. So I think this is an amazing opportunity to sort of share your failure and what you think went wrong back then. And
No, so we failed to raise, right? So this was maybe like, it's totally, we kept the brand, but it was a totally different business, totally different team. We initially started, so right now our core focus isn't necessarily just in healthcare. We're more like an insurance space. We cut across multiple verticals, but then we're building software purely for healthcare. And we'd come out of a program in Dubai back then. We had an angel who was super interested, wanted to like lead the round. It was the first time, right? We're trying to put together the deck. I had a slightly like an advisor who was sort of like very involved in the business back then. So, we'd spend like days like putting together. We built this elaborate like deck. It was so detailed, but by the time we finished all that stuff, right? The guy who wanted to like lead like the round and bring other people was already like it took a lot of time, right? He was already like but again, one thing I realized with that, right? So is changing directions, right? So if because again, I see a lot of like founders who are doing like literally telling the same story. Because again, when you're early, right, it's your story. It's a story, right? Because it's not a real business yet. Like you don't have a ton of validation, you don't have a ton of revenue, you don't have it. So it's really your ability to sort of like tell the story that this will be a big company, right? Which is what investors are looking for, right? Would this be a big company? So for us, the story we were telling, we also just realizing, again, I think if I remember sort of like why that fundraise didn't succeed, it was also because, again, inexperience. I didn't know it's like all the things Paul talked about, pipeline. You need to have a pipeline. You need to like do it like sales. It's not just like look for one person. If they don't give you money, then like you could. So it was, first of all, the story. We took a long time, like, fixating on like details, financial models, decks, all that. We didn't approach like sales and like keep selling, keep looking, and then just knowing that, again, in the beginning, it's all about like storytelling. It's not about like how much traction you have. It's all about how big is this market you're selling, and all that. So yeah, when that didn't work out, so we tried, guy fell through, we tried a few other people, it didn't quite work out. So we went back to the business, right? And, we also realized that what we were asking for, and we didn't have a lot of traction, we needed to prove something in the model to say this would work. So we dumbed it down, pivoted the business, or changed a bit of the business model, and, came back again, like after like, I think that was like 12 months, 18 months, and we got a bit of traction, and we actually finally succeeded in raising. Yeah.
Awesome. Yeah, so Paul, sorry to call you out. Do you have a similar story? I'm sure it's not all been rosy with your raises, but if there's any challenges that you've faced as you've raised, feel free to share.
Okay, so I think I have a bit of a different trajectory. Before I started, I had the opportunity to do a lot of networking, especially when I was in MEST. Those who know me, I was always doing a lot of networking, organizing community events and stuff like that. And so for me, what just happened was, if you know the DFS lab, Digital Financial Services Lab, yeah, the folks that wanted me to help them organize an event in Ghana. And I was like, yeah, I know folks within the fintech space, financial services. I can promote your stuff here for you, getting known in the local community. And yeah, they were like, okay, great, do this for us. So we did that. And after the event, it was really successful. They were like, look, we think you are in MEST, you'll be coming out soon. You're an excellent guy, you're well connected, etc. Why don't you start something? And I told them that, yes, we've been playing with some ideas. And they were like, okay, cool. Come over to Sri Lanka, pitch to Bill Gates and his team, and we'll give you a grant, And so we did that, and we started out with a grant of $50,000, right? And they helped us think through the business and stuff like that. So I think for me, it really, of course, the problem is something I've known a long time because of the industry I've worked in and all of that. But it just started from networking. And I think for me, that's probably one of the best ways of solving problems, building communities. And if you build communities with people with shared interests who think the problem you're solving is, important, those people can bring their network to you. They can open up their network to you. They can open up opportunities to you that would help. And so, yeah, I did a lot of that. It's also being relevant, writing about your experiences, writing about the problem you're trying to solve, looking at unique angles that people don't really see. I spend my time doing a lot of that. Right now, my biggest interest is in the whole Web3 infrastructure, and I'm trying to build a community around that, a learning community around that, so that we could see what the possible advantages are. So yeah, for me, that was my trajectory. From there, it just opened up to introductions, because you just keep on getting so many introductions. Sometimes you can't even handle the introductions. So yeah, that's for me has been my path. So for me, community building is very critical to me, because I think it will open up new ideas and new opportunities to you.
Cool. Thanks, Paul. We will be going through our last sets of questions, but before we do that, please feel free. I'm speaking to the audience. Please feel free to add questions to the Q&A, and then also we will be going through a poll, which is a question that you would probably have to answer, and then we will go through the Q&A. So we're at about the middle point of this discussion. So thank you all for joining. So I think my next question, which is a little bit controversial, has to do with equity stake. Now we all know that money that you end up getting, and Paul, I'll start with you. The monies that you end up getting come it's not a cost, a cost to the co-founder. I mean, that's what it is. Now, what are your thoughts on the demands from investors when it comes to equity stake, and also not just in terms of equity, but sometimes board seats and control of the company? Do you feel like these amounts are proportionate, like these demands are proportionate or disproportionate? As general as it could be, nothing specific. Yeah.
What I can say is that if you're an early stage founder and that's what you're thinking about, then you're not ready to run a business. That's all. Seriously, to be honest with you, I mean, these kind of issues are like issues of 5-10 years ago, when there weren't tools like safes, readily available for you to really think about, how to treat early stage funding. But now there's so many examples, there's so many people to speak to, and there's just so much information online that you can't be worrying about this. Your biggest worry is solving the problem of a customer and trying to reach product market fit, right? And so just to come back to it, early stage, as much as possible, founders should hold on to as much equity as they can. Look for investors who understand you and are willing to invest on the right terms. you don't have any business talking about equity. Use SAFEs as early as possible. I mean, if you start having conversations around equity, then it means you are willing to make that person your co-founder. That's pretty much what you are trying to say. And that's also another decision that has to be taken. If I were you, I'll keep funding team between 2 to 3, not go beyond that, because it makes the conversation way easier. And yeah, speak to other people who have raised funding and ask them if they are willing to tell you how much they give up early on. Typically, I know if you are doing like a pre-seed, nothing above 10% of your company, if you have to do a seed, we still keep, probably maybe not up to, you don't have to go beyond 25%. Make sure that don't go beyond giving up 20% equity to external people by the time you are doing, your Series A. Because Series A is a different ballgame. That's when you are actually talking about equity. Or it's a price round. So now you are the people coming on board are looking at you in a different light. The metrics they are looking at are a bit different. And that's when you start to talk about, the ownership. But don't forget, SAFEs are also convertible, right? They convert at a price round. So even if you are giving up equity under a SAFE, just have in mind, try to model and have in mind how much you are giving away. But yeah, to be honest, at the early stage round, really try to focus on building something sustainable, something that is making money or growing as fast as possible, if that is your metrics, right?
Yeah. Awesome. Yeah, Henry, same question. Really, is this proportionate? What do you think about equity?
No, I fully agree with Paul, right? So thanks for Y Combinator on the SAFE, right? So I think Paul has dealt, he's spoken about that, and I think it was a fantastic answer. It for us delay doing a price round, or delay giving our equity for as long as you can. We haven't done that. We're not even doing that in our next round. Because it helps, right? If you can't, delay it as much as possible, and keep the decision making between like your core team as well, right? So what you also hear a lot is, people who do either pre-seed round or seed rounds, and like they now need to have a board, right? And then like it becomes about governance and like organization and proper structure. Try to, like, if you can stay away from that as early as possible, for as much as possible. Thanks to my advisors that we currently have, which is why it's also good to like have advisors, right? Have other founders. So your biggest, something we always say on this journey, the biggest resource you have are other founders, right? Not just founders who are ahead of you, but also your peers. So quite early on as well, right? When I was fundraising, I happened to have an advisor who's another founder in the ecosystem who's like maybe 2 rounds ahead of me, right? So he said, when our investors were talking about, board, he was like, don't do a board, like say no to board. Say you don't have a board. You're not interested in doing a board yet. So because when if you're a first time founder, you probably don't understand all these things, right? So you probably think, your investors are really not your bosses, right? Like they bought a tiny bit of your company, so you don't work for them. So you just try to make sure, especially when you're pre-seed, early stage, because you don't know what company you're building, right? I remember it was when an advisor who said to me, like, your company can become like a food company in another 2 years. Like, you don't know what you're building, right? So, like I mentioned Paul Graham earlier, right? So what you're optimizing for is growth. What grows, man? Like, if, you were building a company that was selling water before, and like you realize like selling fish grows faster, man. That's what you're building now. That's what you're building now, right? So the challenge with like having investors who aren't aligned early on, or like sit at your board and force you to do, maybe because you said, okay, we're going to do this, like you do something different. Like, so you need to be nimble enough to be able to change. So realize that companies who early on set up all this complex governance. Because early, like Paul said, you're just optimizing for product market fit. Do I have the right product? Do I have the right customers? Can this grow? Right? That's what you're optimizing for. You're not optimizing for if your financials are the best in the world or if you have the best governance structure. No, you do that like from your Series A, Series B, and all that, right? So for me, I would say like for founders, like convertible notes, safe notes. That's the instrument for your first two rounds, pre-seed, seed stage. You can start thinking about like price rounds from like your Series A upwards. And again, advisors, right? So if as much as long as possible, delay a board and just have an advisory board, right? So again, they advise you, but they can't force you to make any decisions, because now when you have a board, it's no longer your decision. It's now a decision of people who probably aren't in the market with you, seeing what you're seeing, and so on and so forth.
Yeah, so many words of wisdom from our panel around equity, board seats, and having a team that helps, an advisory board that helps you. Thanks so much, gentlemen, for both answers. So it's time for the poll now. The poll should come up any minute. Once the poll comes up, feel free to just pick. The poll in question is, what has been the biggest challenge to raising money for your startup? It's a single choice answer. So option A is finding investors. 2 is been convincing them to invest by showing traction and customer value. 3, the cost and availability of startup-focused legal teams. And then a large percentage of equity, which we just discussed. So feel free to answer, and then at the end of the day, we will give you the results of the poll. Whilst we're doing that, I think we will switch over to, and just to give people more time to answer the poll, we will switch over to the Q&A session, and I will be reading some of the questions that have come across, and yeah. Yeah. We seem to be having some background noise. Yeah, no worries. Okay, great. So I think I'll go through the first question with everyone on board, and then feel free. It's actually a question to both speakers. This is an opportunity to share sort of your story, if you can. So how did you start? Where did you come up with your idea? How did you move from ideation to product? And did you bring co-founders in any way? So this is from Mohamed Ba. I don't know, either, let's, Henry, do you mind starting? Because it's, yeah. I hope you heard the question. You're muted.
Is it me or is it Paul?
It's either of you can answer. Henry, your mic is.
Okay,
Yeah.
great. How did I start?
Yeah.
The current problem with solve and approve, I'd always interacted with the problem one way or the other. I used to work in banking, so onboarding customers was always a headache. And that's my first true exposure to the problem. My current co-founders actually joined as employees first. So, and they were my colleagues at Meltwater. Yeah, MEST. So we were first employees, then transitioned to co-founders along the line. That's the advantage you get with MEST. But I think that beyond MEST, it's always important that as an individual, and I'll probably share a resource. There's an article by a fund in San Francisco called NFX. And NFX is really good at helping you understand the value of your network. In fact, they have an article that talks about the value of your network and how you grow based on the kind of people you find yourself with. So one of the decisions I've made constantly when it comes to finding talent is finding myself interacting with more technical people, i.e. people who are operators and people who are engineers. And for me, that pool of talent is very critical. So I try as much as possible to connect with such kind of talent on Slack groups, on Telegram groups, and globally across Africa, as much as possible. If I can network with them, that is great, right? And so for me, if there's anyone who is looking for co-founders, who is looking for people they can work with, you need to do a lot of networking, to be honest with you. But also, you also need to prove yourself worthy, build a brand for yourself, and at least demonstrate some level of competence. That is what will make someone want to work with you, right? And so when it comes to co-founding, I think for Approve specifically, I was lucky because I was involved in MEST, and that's how I met the people I'm working with. But beyond MEST, if you're not someone from the MEST ecosystem, how do you, interact with people? You must always have the goal of interacting with people who know more than you, who are more, knowledgeable, and also be hungry, be a lifetime learner, because you can't be a founder and you're not learning. You'll fall behind, trust me. Like, you think that, you learned a bunch of things in MEST last year, and so you'll still be relevant a year or two. Trust me, you'll be out of the game. Let me put it that way. So you must be a lifelong learner. Twitter is a great place to learn. Sahil has a book called, Sahil is the founder of a startup called Gumroad, and he's also an investor, popular investor. He has a book called The Minimalist Entrepreneur. You need to find that book. And it teaches you really how to become an entrepreneur, how to validate problems, how to think around really solving problems, and building, the right kind of support system for any idea you have or a problem you want to solve. So that's how I've done it. That's how I keep on doing it.
And it sort of answers Divine Agor's question, how you found your investors and where you find them. You're basically finding them in your network. So
yes.
that's a two far. So I'll move on to another question that we have. This is, I think it's based on the discussion that we had, and I think it was sort of answered. And Henry, please feel free to jump on. How long, he actually wants a time period. How long does it take from the process to, how long does the process take in your experience to train the thoughts from conversation to getting funded? So just to rephrase, how long does it take from the first conversation to getting funded? You sort of answered it, but I think he wants an explicit answer.
Yeah, no, I don't think it's not there's no framework, right? Like, it depends on the investor you're dealing with. So I've had investors that close in 1 week. I've had investors that close in 6 months, right? So again, obviously, the shorter the better, right? Because the pricing is straightforward, which is obviously the value of safes, right? So if you're doing a safe, there's no legal, there's no back and forth. You've already agreed on terms. You can literally agree on terms in 5 minutes. If you're early, then maybe you're dealing with people who want to do like due diligence. So if you already have a data room, so you've prepared like a data room, like again, before you can find formats for what should be in the data room, like your finance, whatever they need to do. So you can quickly shoot them a data room, and that makes it easy. So it really depends on the profile of the investor, right? So I've had investors, like I said, doing 1 week, and I've had people also like drag it for 6 months, doing due diligence, asking for many things, trying to talk to all the customers, and so on and so forth. It can also be taking too long can also be a red flag as well. Because again, you see it in the business. So even when the person joins the business, so again, because when you're early, right? So if you have options, again, I understand that we don't know. Again, we don't have massive, ridiculous liquidity that you can be saying no to investors left, right, and center, right? But like, if you have options, biased towards somebody who's willing to move quickly, right? Because it just shows that even when they're in the business, they move quickly. It'll help you, like, it's just a different mindset, but from somebody who drags things, takes forever, tries to, check for a million things and all that, right? Yeah.
Awesome. Thanks for that. Just to follow
let me add to that briefly.
Of course. Yeah.
Yeah. What he's talking about is there are two ways to it, right? The first part is creating a sense of agency. As a startup, you don't have so much time, to be spending time just going back and forth with investors. And so that is why that's why people say build in public. Build in public means that share constantly a track record of how well you've been doing, so that essentially what happens is that it creates a sense of agency, right? You're showing transparency, you're showing that you are growing consistently, and then what happens is that people would notice what you are doing, and so you have a pipeline coming to you. Now, if you don't create a sense of FOMO, what happens is that the investors feel like, you're not on top of their funnel. They don't need to rush to do a deal with you, right? Because that for me is very critical, to be honest with you. And if you don't create that sense of agency, you have investors wasting your time, honestly. So that's why I've always said, build in public, build communities. They help you grow. They create an impression that you are growing really fast and you're one of the hot deals to close quickly. And you will see if investors reach out to you, they'll ask you a few questions. They'll ask you a couple of questions that validate whatever they've heard already, and then they would want to do a deal as quickly as possible. That's why you also have to be ready, right? Because I've done a deal like in a day, right? And they wire money like next day. But if you're not investor ready, and if you are not creating that sense of FOMO, you just, it will become a drag. Also, generally, I think one thing I've noticed, and most founders will say this, one thing I've noticed is that where the investors come from matter. So, for example, European investors are slower than American investors. American investors will just quickly work with you. If they don't see it, they'll just tell you, look, I don't want to do a deal with you. It's okay. I'm gone, right? But if they want to do a deal with you, they'll let you know. Yeah. European investors, they are very traditional. Most of them, not all of them. Most of them are very traditional. African investors those that are popular tend to work with American investors a lot. And so those that have money, they'll do a deal with you. But there are also some that are just a bit traditional, conservative. So you just make your choice as to who fits you best.
Yeah, that's a lot of valuable insights. Knowing, first and foremost, create agency, being ready, also knowing where to get your money and knowing sort of the culture of the investors and how they work. So awesome. I think it answers 2 or 3 of the questions that we have. But just to follow up on that, and to go back to Henry as well, how comfortable are investors in Africa ready to place their money via safe notes? How do we know? Is that something where?
No, I think it's become quite common. I think investors are, it's become quite common. I don't think I've heard, I've also had issues. I've had an investor who preferred like a convertible note because their LPs were super, their LPs was like some American fund that was super traditional, and like they didn't like understand, the safe. They just prefer a convertible note. They know it's there to convert after this time, something, blah, blah, blah. But I wouldn't say I would say that most of all the Nigerian, thanks to IC, right? Most of all the companies on the continent now have gone through that, and everybody's rushing to throw money at them, and most of them are on safe. Most of all their rounds are on safe. So yeah, I would say that African investors are probably fine with it.
Cool. So I think this is the last question. I'll throw it out there, and both of you can answer. You've already spoken to it, but can you outline very clear steps on how startups can be investor ready? You've both talked about due diligence, data rooms. But yeah, if you can, maybe we can start with Paul, and then Henry, you can piggyback if you like. Yeah.
I think first and foremost, don't start a startup just because you want to raise funding. It's very important.
Oh, you're being mysterious.
I'm serious. I mean, you don't start a company just because you want to raise funding. Because one thing I've seen happen, and people forget that these things happen a lot, right? So during 2012, 2010, 2014 era, you had the guys who were big were the Congas and the juniors, and a number of things have happened. People don't know this, right? It was more difficult raising funding then, but those people who raise funding, for example, Conga has had to shut down. It just tells you that, your motives for raising funding should be backing a real business. It shouldn't be something that like you're just gonna perpetually be raising money and engineering. That's what I talk about when I say venture engineering. People are raising and showing optics, right? And the optics is basically choosing a not metric that makes you look good, right? I mean, it's there's nothing wrong with that, to be honest with you. But for me, I mean, and this is my preference, I don't know about other people. For me, in the back of my head, I struggle to do that because I need to feel like I'm running a real business and I'm making money. And I can actually, without funding, I can run the business on my own revenue for a while, right? That's the kind of feeling that I like to have, right? And so, yeah, that's the first thing I want to say in terms of the mentality. The second thing is that, yeah, of course, if you need to raise funding, like I've said already, do the right kind of due diligence, right? Put all your deal room together, put your documentation together, but more importantly, show the traction, right? If you can show the traction by building the right kind of community around your business, it helps, right? So that, because at that point, a good investor, a good pre-seed investor won't be asking you for too much. They will ask you for just the things that matter. They want to see that your business has momentum and is growing, and so that's what you want to show. And so that's for me, I think is really important. And of course, this depends on the kind of business you are building. Network a lot with other founders. Of course, not everybody will be straight ahead willing to network because, I mean, if I don't know you, I don't know you. I must have some kind of introduction from someone before I get to, get cozy with you, that kind of thing. And so do those things and it will help. Honestly, the best way to fundraise is to get introductions. And if you can get introductions, that helps.
Cool, thanks. Henry, anything to add?
Yeah. So I agree with Paul, right? So I agree with Paul, build a real business. But I think I don't disagree, but I think I want to throw in slightly a slightly different view to doing startups on the continent, right? So you're really trying to change, you're trying to build a business, but you're not trying to build like a regular type of business. If you're doing a tech startup, you're trying to create something totally different that probably doesn't exist. So it's very difficult, right? If you're an operator, and I'm an operator, right? I'm a tech guy. I like to operate. It's very difficult for people like us to build very big businesses because we want to like build the thing. Like we want to make it work. We want to make sure people are doing it. Like it's a totally different mindset to build a high growth business. Your job is not to build the business. Your job is to tell the story, get the capital, and get people to build the business. It's a totally different mindset, right? So me, I'm a tech guy. I wrote code for a bit. I sold for a little bit, but I know absolutely nothing about insurance. There's probably some dude has been in insurance for 15 years. He probably is the better person to build an insurance business, right? So my job is to figure out what kind of world are we trying to create, that things are better and different, right? And then assemble the people to do that. Get the best people who, so I see founders. So again, when you sort of like look at the companies that are growing very quickly, right now, I've studied them and most of them are my friends as well, right? So because you see, I've been on this journey for a little bit. bootstrapped, we did the work, and then you see all those guys, and then you try to understand the model. You sit down with them, and then you realize, because we didn't invent this model. We're basically copying things that like have been built in Silicon Valley, right? There's a course on YouTube, right? If you're here and you're trying to be the starter, you should probably go look at it. It's called Blitzscaling, right? It's a series from Reid Hoffman's book, Blitzscaling, right? So they did like a 40-50 video thing, right? That talks about like high growth. So when you watch that, so it's a different mind. So there's something he said in that video, right? There are only two places in the world that understand how to build high growth businesses. That's Silicon Valley and China, right? That's the only places where you see ridiculously high growth businesses. I forgot in a conversation I was having yesterday, and somebody was pointing out that Amazon wasn't profitable for 23 years. Now they're the biggest company in the world. Tesla is the most profitable. Tesla just became $1 trillion company. That's not a profitable company. So it's a totally different mindset if you're trying to build, because you're inventing totally different business models. They don't exist. So I would implore founders, yes, try to build a real business. But if you're building a high growth business, your job is not to run the business. I would disagree. I would say that your job is find the right talent that is 10 times better at you in running that business, and find the capital to get them to come and work on that vision. So it's totally different. Now, are you able, is everybody really able to be able to tell that story and get the capital, right? It's not that easy, right? It might not be, because you settle for, and I was having a conversation, I think it was an investor. No, actually it was another founder, it was Mike for Boost. And he was telling me, unfortunately, when you don't have enough capital, you hire junior people or mid-level people, and then you end up doing the work yourself. So, imagine if I want to hire Emmanuel now. Emmanuel is been through the journey. I want to hire him. Emmanuel, how much am I going to pay you to push you from Microsoft there?
For another time.
but anyway, so summary to that is, yes, try to build a big business, try to build a real business, really. But to understand, we're talking about fundraising. Fundraising has nothing to do with your business. Fundraising is all about storytelling, right? And people who understand this are the people who are able to raise money. Because in the beginning, investors don't care about, right now, I'm in 3 countries, I have 2,000 hospitals, a bunch of 11 insurance. That's not what they care about. They want to know, dude, how do you build $1 billion company? That's what they want to know. How do you have 20,000 hospitals? How do you have, all the insurance companies across emerging markets? And that is not, you can't show it. You can only tell it, right? So you can convince them by telling a story. So I'll try and put that in there, because that's helpful.
Cool.
Yes.
So anything to add before we sort of wrap up? Yeah.
So I agree with the idea of storytelling. Storytelling has different angles to it. It really depends on what matters to you as a founder. Don't forget the stories we tell, like Blitzscaling, the stuff you read, Blitzscaling and stuff like that. You're reading things that people have done, like, in different markets. And we try to apply some of these things to Africa, and it always doesn't end well. That's the long term. In the short term, you get your money. In the short to medium term, you spend funds, but you end up realizing that maybe sometimes the market, and this is a true story about Africa. The market really, especially if you're building your business and a chunk of your revenue is coming from Africa, you realize that the market sometimes can't just support the kind of business that you are trying to build, right? And so I tend to look at stories more from markets that look similar to us, India, Southeast Asia, and that's only if you want to build businesses in those markets, right? In emerging markets. You want to look at businesses and see, for example, Africa is very fragmented, right? So blitzscaling is like, it's a story that is just for, markets that really are well developed. You understand? Ask yourself, why do markets also, entrepreneurs, most of the funds that are raising, why do they quickly have the need to, go out of their markets, their initial markets. It's because the economies we are operating in foundationally are not that strong, to be honest with you. I'm not going to lie to you, right? And so for me, always, I prefer to be the entrepreneur who has a peace of mind. When I'm going to bed, I know that I'm doing something, that makes sense, right? And just build your foundations. And you get a lot of what I'm talking about when you read from Jason, people like Jason Yoku. Subscribe to him, read about the realities in the market, right? That's just my opinion. If you're raising money, raise because you are backing a business that makes sense. Of course, it's going to grow fast. You are building things in markets that have real economies, and not just some made up things. Let me put it that way.
Cool.
I mean, you could always build a vision, but the vision would translate into reality over time. And if that vision is not backed by the real economy, the long-term sustainability of your business doesn't really matter. And for me, that's just my preference. Maybe because I'm from a background in finance, I want to see that what I'm building is real. So that's just it.
Thank you both. That's amazing submissions from both of you. The poll results should come up, and we should see. So really, I think the biggest challenge from the audience seems to be finding investors, and some of the answers to this have already come up. Network, join groups, follow people on Twitter. We've all joined accelerators and different groups. All these things help you find investors, and then also talk to other co-founders, founders who have found investors. So all these answers have been provided. We are at the end of our time, but then just to sum up, I really want to give Henry and Paul, first and foremost, thank you for honoring our invitation. First, tell us, I'm giving you 2 minutes to sort of tell us what's happening, what's next. If there's any message you sort of want to push out there, maybe you're hiring, maybe you're doing something. So maybe you're fundraising, maybe there's an investor on the call. So 2 minutes, real quickly, so that we promote, approve, and Curacao.
Well, my business is largely a B2B business. So a lot of the time, what we spend our time doing to promote the business is more looking at how we can generate content around the business and reaching out to decision makers in the B2B space. And so that's really what we spend our time doing. Right now, on a personal level, I'm just exploring new technologies and how we can take advantage of new technologies, because the internet is evolving, and if you are not, as a business, if you are not researching new technologies that can help you build new models, you'll fall back. I think that I'm very excited about the new models, things like DAOs, DeFi's. That's what the future will look like. We'll be building a lot of the internet based on these new systems. And you see, the interesting thing about Web3 is that it's not just technology. It is innovation based on a sense of thinking, right? Like the way your organizations are set up now. So DAOs basically make that a new thing, like the idea of having centralized, one head making the decision and all of that. It changes, it turns it up. So I'm happy it's not just about tech, but it's also about a system of thinking, which is really interesting for me. And that's where we are looking to build new things around. I'm not currently fundraising per se. I'm just focused on closing big clients. So if you have big clients for me, bring them my way.
I'll do my best to find a few referrals. No worries. Henry, your turn.
All right, cool. Thanks again. Thanks for the platform. I like to help other founders. So if you're building out, if you're working on something, you need advice, feel free to add me on LinkedIn. I'm happy to when I have time, jump on the call, give you a feedback on what you're working on. We're hiring as well, so we're scaling across multiple markets. So looking for talent. We're looking for business development, customer success talent in East Africa. We're looking for customer success, business development talent across French-speaking Africa as well, North Africa as well, Egypt, some of those markets. So we're looking for talent like that. Most of our team currently sits in Nigeria, Ghana, a bit of Kenya. So if you feel like what we're working on is super interesting and aligned with what you want to do with your life in the next couple of years, please reach out to me. I'm happy to take out. We haven't started fundraising, but we're having conversations to start raising in another few weeks. So well, fundraising really, but we're only just talking with founders right now. We're only taking checks from founders. But yeah, if you're a VC or something on the panel, yeah, feel free to connect to probably share some of our materials in the next couple of weeks when we open up the round for other people. Cheers, everyone. Thank you.
Yeah, awesome. Thank you both for joining us. Just to give you a sense of what's coming up next, tomorrow we have a session on Ask an Investor. So we have an investor actually coming on. We have Lavanya Anand from Vested World, who will be joining us, as well as Ashwin, the Managing Director from MEST Africa. This session will be at the same time tomorrow and will be moderated by another MEST alumni, Amishadai Ofori. So looking forward to seeing you all here and joining the conversation. Again, thanks to the panel for joining us, and thank you for joining us as well. It's been a pleasure and looking forward to seeing you around somewhere. All the very best. Thank you.